Okay, let's unpack this. We're diving into Zoom's Q1 fiscal 26 earnings call today.
Yep, got the transcript, got the numbers.
And the goal here is simple. Cut through it all, get you straight to what really matters. You know, the key results, the strategy stuff management talked about.
Exactly. Think of it as your fast track. We'll hit the highlights, the main numbers first, then dig into the deeper conversation, AI, the platform push, how they're dealing with things right now.
All right, sounds good. Let's jump right into that Q1 snapshot then. How did the quarter look financially?
So revenue landed at $1.175 billion. That's up about 3% year over year.
Okay, 3%.
And what's interesting is that it beat the high end of their own guidance by $8 million. And, you know, they did that even with one less day in the quarter compared to last year.
Huh. Beating expectations, even with that calendar quirk. What about the different parts of the business? Enterprise.
Enterprise was solid, grew about 6% year over year. And it's now like 60% of their total revenue.
60%. So up a couple of points from last year.
Yeah, exactly. Shows it's becoming even more central.
And the online side, that's, I think, some challenges, right?
It has, but management sounded pretty encouraged. They talked about signs of stability. Average monthly churn was 2.8%.
2.8. How does that compare?
Well, it's a 40 basis point improvement year over year. And importantly, they said it's the lowest churn they've ever had for a first quarter.
Wow, lowest ever for Q1. That actually sounds pretty good for the online health. What about the bigger spenders, the large customer?
Yeah, those customers spending over $100K a year, that group grew 8% year over year.
Okay.
And just like the overall enterprise segment, these big guys make up more of the revenue now too, about 32%, also up 2 points from last year.
Got it. And net dollar expansion for those enterprise folks, NDE.
That held steady. Quarter over quarter was 98%.
98. So not really expanding much within the existing base, but not shrinking either?
Pretty much. Seems like they're holding on to their current spend, even if, you know, getting big upsells is maybe tougher right now.
Makes sense. So with those revenue trends, how did things look further down the income statement? Profitability.
Non-GAAP income from operations. That grew 2% year over year. Came in at $467 million.
And that was ahead of guidance.
Yep. Beat it by $22 million. The operating margin was 39.8%, slightly down year over year.
Why a slight dip?
They pointed to a couple of things, changes in their bonus structure and ongoing investments in AI.
Okay. And the bottom line, earnings per share.
Non-GAAP EPS looks strong, $1.43 per share.
That sounds like a beat too.
It was 12 cents above their guidance and 8 cents higher than last year. They said it was down to the solid results, but also fewer shares outstanding because of their buybacks.
Right, the buybacks. Let's touch on the balance sheet and cash flow too.
Sure. Deferred revenue was up 5% year over year, about $1.43 billion. RPO remaining performance obligations, that increased 6% to roughly $3.9 billion.
And how much of that RPO do they expect to book soon?
They expect to recognize 61% of it as revenue in the next 12 months. That's up a bit from 59% last year. Could mean slightly better visibility, maybe? Or just contract timing.
Okay. Cash flow.
Look pretty healthy. Operating cash flow was $489 million. That's a 41.6% margin. Free cash flow, $463 million, so 39.4% margin.
Still strong margins, but you mentioned they were down a bit.
Yeah, slightly year over year. They said it was mainly just timing differences on tax payments. And they finished the quarter with a lot of cash, around $7.8 billion on hand.
And that buyback program you mentioned affecting EPS, were they active?
Oh, yeah, very active. They've really stepped up the pace in Q1. Bought back 5.6 million shares for about $418 million.
Wow, that's quite an acceleration from the previous quarter.
It is. Up by 1.3 million shares bought quarter over quarter. Shows they're serious about it.
Okay, great overview of the numbers. Let's get into the strategy talk from the call. Seemed like AI was front and center, right? Even the CEO's intro.
Totally. Using that AI avatar, that was, you know, a very deliberate signal about their AI-first approach. Pushing boundaries, they said.
So framing AI as key for cost savings, productivity.
Exactly. Yeah. Delivering real value for customers. And they talked about specific things they launched or improved.
Like what?
Things like Zoom tasks, AI helping with Calendar Manager for scheduling and finding focus time, and then the big one, Custom AI Companion. Plus, they made those industry-specific tools generally available workplace for frontline workers and for clinicians.
How's the basic AI companion doing? The one that's, you know, included for paid users?
Adoption's really taking off. Monthly active users jumped nearly 40% just from the previous quarter.
40%? Wow.
Yeah. They mentioned Raymond James using it for meeting summaries, showing how it helps, like Financial advisors cut down on admin work, and they stressed again the core AI features. Still no extra cost if you're a paid user.
But the monetization angle, that's custom AI companion, right? That's where it gets interesting from a revenue perspective.
That's the plan. That's the potential upsell. They said early feedback from trials, including some big global 2000 companies, is really positive.
What features are getting traction there?
Seems like it's the ability to customize it, like integrating the AI with a company's own data. Bring your own dictionary, or index, they called it. Also, custom meeting summary templates and links to tools like JIRA.
And they're using it themselves.
Yeah, rolling it out internally to their own employees, the Zoovies, to tack into internal knowledge. Kind of eating their own dog food, proving it works. That's the path they see to new revenue from advanced AI.
It makes sense. Okay, beyond AI, they also really pushed the Zoom workplace and the whole platform idea. How's that playing out?
Yeah, the narrative is use Workplace as the hub, and that pulls people into other products, phone, contact center, Workvivo.
Any good customer examples?
They gave a few.
Yeah.
The Boston Celtics, the NBA champs, they upgraded to Workplace Enterprise Plus, added Zoom Phone, and brought in Workvivo for employee experience. Shows it's not just for standard office setups.
Interesting. Any big wins against competitors mentioned, like displacing others?
Yes, definitely. A big financial institution signed a deal over $1 million ARR for the collaboration platform. Management made a point of saying this customer was simplifying, moving away from other tools, including Teams.
Taking share from Teams, that's notable.
And they said this deal really shows the better together idea, collaboration, plus customer experience. And they're already talking about upselling them to the CX platform too.
And you mentioned the channel playing a role in these broader deals.
For sure. They highlighted a win with Doc's Dermatology Group, brought in by a partner. That group took Contact Center Elite, plus phone and Workplace. Unifying everything shows how partners are key, especially in specific industries like healthcare for these bigger multi-product sales. And digging into specific products, Zoom Phone, still growing well. Yep, mid-teens growth. They said a key factor is integration, especially the integration with Microsoft Teams. That's seeing significant uptake, lets them win deals even in team shops.
Right, meeting customers where they are.
Exactly. And they keep mentioning the huge opportunity still out there replacing old on-premise phone systems. Like 150 million seats globally still need upgrading.
Wow. Okay, and the customer experience stuff, CX Contact Center, that sounds like it's really gaining momentum.
Oh, absolutely. This is clearly a major growth area now. They said the whole CX offering, just 3 years old, is now a triple-digit million ARR business.
Triple-digit million ARR already.
Yeah, and growing in the high double digits. Zoom Contact Center specifically saw customer numbers jump 65% year over year in Q1.
65% customer growth.
And their AI bot, Zoom Virtual Agent, landed its biggest deal yet as an upsell to a contact center customer. They gave another example, MCAST, a customer using Workplace and Phone who then added Contact Center Elite. It fits that unified platform story perfectly.
Gotcha. What about a Zoom Revenue Accelerator, ZRA?
That saw strong growth too. Licenses up 72% year over year. They mentioned Goosehead Insurance, already a big phone customer, adding ZRA for their sales team to use the AI features.
Okay. And Workvivo, the employee experience platform.
Yeah, that one showed really impressive acceleration. Total customers up 106% year over year.
Doubled.
Wow.
Yeah. They said some of that was the Meta partnership migration, but also lots of new wins. They do expect that Meta boost to kind of normalize later in the year, maybe second half.
But still, significant growth.
Definitely. And crucially, they noted, like 90% of Workvivo customers are actually new to Zoom entirely. So it's a great way to get a foot in the door and then introduce the rest of the platform.
That's a smart angle. Yep.
Yeah.
So lots happening across the product suite. You mentioned partners earlier. They talked about a big channel transformation too.
They did, yeah. Said they did a major overhaul of their channel systems and processes just in Q1.
Like what kind of changes?
Expanding the partner network, changing up incentives, and really speeding up the whole process for partners getting quotes out, closing deals, taking it from, hours down to minutes, they said.
And is that paying off? It seems like it. They directly link these channel improvements to big wins in Q1, especially for phone and contact center. Those are areas where partners often have a lot of influence and can add value. They noted a significant chunk of CC and phone deals are now partner-led or influenced. And they also mentioned a new big partnership with Bell Canada.
Okay, so strengthening the channel is clearly a priority. Let's shift gears slightly. The macro environment. How did management talk about that? Still cautious.
Yeah, the term was uncertain macro environment. They saw good demand generally, especially online, but they flagged a bit more caution specifically for the enterprise segment.
Caution how?
Based on Q1, they saw some larger U.S. deals taking longer, prudent sales elongation, they called it, and more scrutiny on deal terms.
So deals aren't necessarily being lost, just stretched out.
Exactly. They were clear it wasn't losses, just delays and more negotiation. But it's enough to make them slightly more prudent in their enterprise outlook.
And that feeds into their guidance, I assume?
Right. For the full fiscal year 26, they actually raised revenue guidance slightly by $15 million. The new range is $4.8 to $4.81 billion.
So about 3% growth year over year at the midpoint.
Yeah, about 3%. And that raise includes a better outlook for the online business.
Partially because of that price increase?
Partially, yeah. They put through a small $1 increase on the monthly Pro SKUs.
Yeah.
So better online outlook, offset a bit by that more cautious enterprise view. They also nudged up guidance for non-GAAP operating income and EPS. Free cash flow guidance stayed the same, $1.68 to $1.72 billion.
Okay. And for Q2 specifically?
Q2 revenue guidance is $1.195 to $1.2 billion. Again, roughly 3% growth year over year at the midpoint. Non-GAAP operating income, $460 to $465 million. And non-GAAP EPS, $1.36 to $1.77.
And that EPS number doesn't factor in future buybacks?
Correct. It's based on about 310 million shares, so any further buybacks would be upside to that number.
You mentioned that $1 online price increase on monthly Pro. What was the justification?
They framed it as pretty modest, reflecting added value like doubling storage limits. They felt the record low churn and the mix of customers supported it.
Any plans for more price hikes?
They explicitly said no further plans at this stage. And overall, the guidance suggests they expect the macro environment to feel pretty similar to how it felt in Q1. Not getting worse, but not dramatically better either.
Got it. Okay, one last area of capital allocation. We touched on the buybacks, but that accelerated pace was pretty significant.
It really was. Spending $418 million on 5.6 million shares in one quarter, that's a statement. They said it shows reinforced confidence from management and the board and a real commitment to shareholder returns.
How much is left on their current authorization?
About $1.2 billion remains from the original $2.7 billion plan. And they stated pretty clearly their intention, their expectation, is to actually complete that remaining $1.2 billion buyback within this fiscal year, FY26.
Wow, finish the whole thing this year. Okay, so let's try and synthesize all this. We've got the results, the AI push, the platform story, the macro caution, the big buybacks. What's the bigger picture here for Zoom? What does it all signal?
What's really fascinating, isn't it? You're seeing this company actively pivot, moving hard beyond just meetings into being a true platform player. Phone, contact center, Workvivo, JIRA. These aren't just side projects anymore. They're becoming really significant pieces.
And AI is like the glue holding it together.
Kind of, yeah. It's both a feature to drive adoption, like the free AI companion, and increasingly a way to make money with custom AI. Plus, it differentiates the newer stuff, like the virtual agent and contact center.
And that tension between the stable online business with its low churn and the slightly cautious enterprise outlook, that seems really key right now.
Totally. The online stability is maybe underappreciated, but the enterprise caution, the deal scrutiny, it shows that even with good products and winning deals, the macro still bites at the high end. It really highlights why growing those other areas like contact center is so crucial for them.
Yeah, that contact center growth, becoming a triple-digit million ARR business, that feels like a genuinely new, strong pillar for them.
It absolutely does. And that channel transformation they just did, if that really works as intended, it could pour fuel on the fire for phone and contact center growth since partners are so key there.
And meanwhile, they're using that big cash pile to aggressively buy back stock.
Which signals management thinks the stock is undervalued, right? And they're committed to returning that capital. Finishing the remaining $1.2 billion this year is a strong signal.
Okay, this has been a really thorough deep dive into the Zoom Q1 FY26 earnings call. And just a reminder, as always, what we talk about here is for information and context only.
Yep, absolutely not financial advice. We're just breaking down what the company said and what it might mean based on the call itself.
Right. But in that spirited discussion, let's throw out a couple of thought-provoking trade ideas. Again, not advice, just what-ifs based on the call.
Okay, fire away.
Idea 1, you go long ZM. The bet is that the contact center business, with its rapid growth, triple-digit ARR, and especially that AI-powered virtual agent, is so much stronger and more underestimated than people realize. Maybe its growth alone can offset any enterprise sluggishness much faster than the market expects, leading to a re-rating.
Okay. Betting on the CX momentum really surprising to the upside.
Yeah.
I like it. What's idea 2?
Idea 2, also long ZM. This time, the bet is on custom AI companion monetization. The idea is that its ability to tap into a customer's own internal data, that bring your own dictionary thing, is a killer feature competitors can't easily match. So maybe those enterprise trials convert into huge high-margin upsells way faster than anticipated, proving their free core AI pay-for-custom AI strategy is the winning model.
Right. Betting that the custom AI piece becomes a major revenue driver much sooner than baked in. Both are interesting angles based directly on what management emphasized in the call.
Definitely hypothetical, of course, based on potential interpretations.
Natural.
So maybe the final thought to leave everyone with is this. Zoom keeps talking about becoming a system of actions, not just communication. Thinking about that and their AI-driven platform strategy, how might that fundamentally change where they sit competitively in the next few years, especially with the macro uncertainty and how work itself keeps changing?
That's the big question, isn't it? Something definitely worth mulling over.
Thanks for joining us for this deep dive.